Going live. Let's see if it worked here. I think we're live. Welcome everyone to the Mike Rosehart Show on the main channel, not the alt channel. So if you're just joining again, welcome back. It's been months since I've done a live stream on the main channel, and a lot has changed. In my life, a month is like forever, and like last month I had like a different number of properties, and now I own a business that I didn't own. I own Choice One Medical company in Toronto. Didn't own that last time I was on here, right? And it's amazing. So much has changed. My second daughter was born, if you're just new back to the channel. So a lot has obviously changed along the way. And hey Mike, watching. So someone's on, watching commercial. I wonder how to turn that off. Disable the ads. I wonder if I can do that. Monetize with ads? No. Let's turn that off.
Monetize with super chats though? Different story.
Correct. Let's see if I can get that off and then on again. Hang on. I'm going to go live again. People are stuck watching commercial. I don't want that. Let me go back here and stop streaming. Okay, I think we're back. Oh, I'm on the same stream again. Oops. Someone tell me if we are still on the stream. Sorry if there's commercials. I tried disabling the ads. I think they're disabled now. I'm used to being on the other channel that has no ads, and so now we're on the main channel again. Okay, so what has gone down in the last little while? So much. William, good to see you on. Andrew Howe, good to see you on. Hello. Okay, so clicking over here, opening the chat up. There. Can people hear me loud and clear? Can you see me loud and clear? Hopefully you can see me okay. Hello, Janice. Good to see you on. Hello from New Jersey. Good to see you. Welcome on. We're going to talk today about what I've been up to in the last few weeks, the business that I've bought. I mean, all of the businesses that I currently have going, why I'm doing some of the things that I'm doing. And then, of course, we're going to get into the live Q&A, which is where you guys bring the questions and I answer them. For those times in the comments where I don't give sufficient answers, because I try to respond to every single comment. For those times where I don't, sorry, my phone was ringing. For the times that I don't, this is your chance to post that comment and have me answer. This is the time. Also, during this stream, it would be cool if now we're on the main channel, if we can get the super chats going. If anyone feels like helping out, Kyle and I have been volunteering to do this for a long time now, like almost a year and a half. And the equipment does get expensive, and I'd like this to at least break even. That would be the ideal, is that like when we buy equipment, that it at least pays for that. So that'd be cool. No expectation. I'm a big guy on frugality, so I totally understand.
Trivia them on how much that costs.
Kyle just sent this. Look at this camera. Lens. Sorry, it's just a lens. It's a huge lens.
Trivia them. See how much.
Yeah, what do you guys think this thing costs to provide the quality video that we do? Is this lens like a couple grand or something? Like $2,000.
$2,000.
Or like, how about this? Tripod, that broke. See the spring hanging out?
$50 tripod.
Yeah, $50 tripod, gone. It broke. So things break, wear and tear. There are costs associated with that. So such is life. So it's been a lot of weeks now since I've been on the main channel again. So I'm sure people aren't expecting my Wednesday at 7 p.m. on this channel. They're expecting it on my other channel. But I figured, what the heck, let's do it. So here we are. If you have any questions at all, jump in and we'll answer them. What have I been up to? So I bought a company with two friends called Choice One Medical. It's in Etobicoke in Toronto. And we sell we actually have patents on products that we manufacture in China, and then we sell them all around the world. So in Australia, in Europe, in the United States from 2 different depots, and then we have a warehouse as well in Canada. And there's plans for further expansion and tons going on there. So don't want to talk too much about it because I know this channel is more about personal finance, but that's what I've been up to, is buying a business and going through that process. And we make medical equipment specifically for CPAP machines. So we have an exclusive patented battery for backup, as well as external power source, and then all the things like hoses and brushes and cleaning supplies. Like we have some of the best medical grade cleaning wipes and soaps, and we have wipes for kids and stuff like that. So there's a ton of cool stuff that we have. So a lot of our products are are out there, and mostly business to business sales, but some business to consumer sales too. So, Tyler, thank you for the $2 super chat. That means a lot. Thank you. Appreciate that. If you have any questions, put them in the bottom there. Can we raise the volume? Yes, we could raise volume. How do we raise the volume? Audio gain.
Oh, that's on that one.
There. That did something. That definitely did something there. That was it. I think that's loud enough there.
Okay. Yeah, that one's a little
Volume
louder.
low and looks choppy. Okay, so I don't know why it's looking choppy. We can't get a focus on me. Click on the camera and turn the autofocus on.
The camera's fine. It's not the camera.
There we go.
It might be the
Yeah, it was blurry. It wasn't focusing. It found my face now. There we go. Frame rate is choppy. Not much I can do about that. I don't know how to change the frame rate on... how do we change the frame rate?
It's not the camera. It's 100% your internet.
It's just the internet connection.
It's your internet connection. You've been having problems with it. At least
I saw your Facebook. Glad I got to tune in. Hey, right on. Awesome. Yeah, so we're on the stream. Hopefully the stream is, somewhat half decent. My internet, I have the gigabit package, which is like 1,000 Mbps. It's supposed to be the fastest package. But again, I'm sure that people are currently on the internet also using it. So like my family's probably streaming something for my daughter, and my mentees could be on the internet. I'm not sure, but that could be part of the piece. I don't think it's the camera. The wire's probably intact. I was seeing the input being blurry there on the screen here, so I know that like for a minute it was probably the camera, but if the frame rate's choppy, I'm not sure what that could be, other than maybe a setting on OBS or possibly the camera focus.
It won't be OBS.
But
it could be the computer too.
It could be.
14 billion.
It's looking good now. Like it was actually looking blurry, but it's looking pretty clean now. So hopefully people can hear and see.
Yeah.
I don't know. I can't see what you guys can see, so I don't know. But okay. So Tyler sent in $2 super chat. So Tyler gets the first question, no matter what. So I'm just gonna wait for his question to pop up and kind of talk about what I've been up to. What is the Mike Rosehart ecosphere? And it currently, I'm a real estate agent. As you guys know, we have a real estate team. So there's 2 other agents. We're a 3-agent team focused on buying and selling. So if you're looking to buy a property in London or sell a property in London, we do that. Obviously, the YouTube is a large commitment. I spend at least 10 to 15 hours a week on. That's a commitment that I'm involved in. Of course, we got the construction, the property management companies, the holdings companies, my personal properties. Let's not forget lending and things like that. If I do any coaching, just bought a medical business, which I'm actively involved in, having to drive to Toronto now at least once a week with that piece as well. And there are many other things that I have irons in the fire about, such as my mentorship program, where I spend a lot of time with my mentees, helping them get properties. Stay tuned, because the videos are coming on that. One of my mentees is closing their 3rd deal. They're going to have over $1 million in real estate, going from 0 to $1 million in real estate in like 6 months. So I'm transforming their lives, and that's a ton of fun, watching my mentees. Like Kyle's getting now his 2nd property. Jonas is getting his 3rd, and these are like large properties, like 4-plex, and the other one has 6 or 7 bedrooms in it. And so there's a lot of potential on Airbnb and so forth, and etc. And then Michael's got his triplex as well. We're closing on very soon. So a lot of things going on in the sphere, especially with a newborn who is now like 6 or 7 weeks old. So a lot of things have been going on. And so, yeah, I'm definitely feeling like burnout is close. But my way of coping with that is knowing that I'm doing it by choice. Like every time I get myself in over my head and I've committed to like 20 people and I have all these employees and people relying on me, I think back and I say to myself, like, Mike, you're here by choice. And if you don't want to do it tomorrow, you don't have to. That's the beauty of financial freedom and having unlocked financial independence. But how do you want to handle the situation? And so when I go back to that happy place of like financial independence, safe, doing this by choice, I'm like, hell, I made these choices that got me here, and so I'm going to get myself out of them. And probably you're going to see a bit of winding back on the real estate side. You see me buying less properties. I had a goal of buying a property a week. That's scaling way back. I have no desire to buy a property a week anymore. We're scaling quite a bit back, focusing more on buying. I have a flipping company as well. I didn't mention that, but doing a little bit of flips in my Ivy Elite Real Estate Ltd Corp, where I'm doing a bit of, like, I borrow people's money and I'll invest it into flips and then turn their money around and get it back to them. I'm going to do a little bit of that, like, probably a property every quarter or something, maybe 4 properties a year there. Still gonna do my buy and holds. I got my land development project, all the things I got on the go. I'm gonna continue to keep buying properties, but probably at a cadence of like once or twice a month. So, yeah. Okay, let's see. So Tyler did ask a question. I'm going to scroll down and I'll go back up, I promise. If you want to invest a large sum of money today, 100% passive, and you didn't need the money for 15 years, what would you buy? Would it be stocks, bonds, ratios, 60-40, 80-20, or even 100% equities? Tyler, thank you. Appreciate the question. I will answer your question because you super chatted. And if people are watching this, and you're watching it for months and months and months, and you're finding some value, toss in a super chat. It'd mean a lot. It's a donation to Kyle for better equipment, so that'd be great. Okay, so, and it would tell YouTube that our content is good because if YouTube's making money, they are happy. They want to promote the content to a greater audience. So, okay. What do I think about a large sum of money that's 100% passive? It depends what a large sum of money means to you. Like, how much would a large sum of money be? That would be a piece of it, I guess, as well. If I wanted 100% passive, I'd go one of like 3 routes. Number one, I would say probably the number one thing I would do with my money if I had a large sum would be put like 20 or 30% with a real estate investor. I'd find someone who's young and hungry like myself, and I'd joint venture, JV with them, and give them like half the profit, and I would take like half the profit or something, and I would mentor them through the process, but they would do all of the work, right? And I'd be 100% passive in that respect, but I would provide the financing. Just because I know the return on investment with levered real estate is probably like 30 or 40% return, the highest rate of return, relatively low risk because it is Canadian real estate. So that's probably the first place I'd put some of the money. But again, you need a large portion in equities, I think, for that. A, it's passive, and B, it's diversified well, whereas real estate maybe isn't so diversified, buying a few properties. So I'd probably buy, again, like exchange traded funds or ETFs with the remaining amount. I substitute real estate and private lending for bonds. So I don't believe in a bonds mix at all. I have 0 bonds in my portfolio. I will have equities, and then I'll have like real estate. And real estate provides really strong cash flow. And where I'm worried about it being passive, I bring on a partner, or I do first mortgage lending. There are guys who will do first mortgages 70% loan to value, right? So you still got 30% of a drop before you even lose a dollar, right? So you got first secure position on the property, go 70% loan to appraised value, you're relatively safe, and you get like 10, 12% sometimes. That's possible depending on how bad people need the money. So that's a safe, well-performing bond in my opinion. And the beauty is you can go see it. You can go touch it. The risk is, in my opinion, lower than some of the other bonds I see on the market. I mean, not probably lower than like government bonds, I guess, but depends. If it's mutual, like on the municipal level, then you're going to have obviously a higher risk than I would say even owning real estate in that municipality. So you got to think that through. For me, that would mean, again, like a lot of dividend income because it's tax preferred. The nice thing about investing in real estate and equities is if the real estate market tanks, all your money wasn't just in real estate. But even if it does, and even if all your money was in real estate, the beauty is rental income is consistent in times of recession. People still need to live somewhere. So what you end up seeing is a little bit higher vacancy rate, but relatively flat on the rental unit prices. So that's really important, I think, because it ensures that if you, let's say you have a recession and you have a 20% drop in real estate prices. If you're cash flowing $1,500 a month from rental income before that, you continue to cash flow about $1,500 a month through that recession. So your mortgage gets paid and you still got $1,000 or $1,500 a month coming in. Of course, you want to have that contingency budget set aside in case something pops up with the property, because in a recession, you're not going to be able to refinance very easily. So you need to have that money set aside for emergencies. But yeah, real estate is beautiful because when you lever up, you guarantee a higher rate of return. If your cost of debt is like 3% and your return on asset on that real estate piece is 8 cap rate, 7 cap rate, 9 cap rate, the difference is levered 5 to 1. So you get like a 30 or 40% return on investment before appreciation, even if the market dips. That's what makes real estate so attractive. What makes real estate not attractive is the work. It is a lot of work. Placing good tenants, managing tenants, evicting tenants, renovating units, all of that is a lot of work. I don't recommend it for anyone. It is a terrible retirement lifestyle. I hear guys come on and say, I got 10 properties, I'm going to retire. I'm like, that's great. Do you have a manager in place? Is it all stabilized? Have everything been renovated and it's just stabilized? And it's like, well, no, I got to renovate 3 properties still. And I don't have a manager. I'm doing it all myself. That's not retirement. That's like picking real estate as a job. It's not the most desirable option. So keep that in mind. Bring on the right people. Bring on the right manager if you want to make it passive. But again, equities are great because you don't need that expertise. Like in real estate, you need to know what you're doing in order to. Oh look, William just did a super chat for $10. Sweet, thank you. Appreciate that a lot. That does mean a lot. If you have a question, William, your question's next. Promise. So yeah, the long answer is I substitute real estate or private lending, which is like lending against real estate. They get 10 or 12% return, consistent, guaranteed. I'll go 60 or 70% loan to value on the real estate. And imagine that situation where you got $1 million house in Toronto, you put a mortgage on it for $600,000. The market crashes. The house is worth $650 instead of $1 million. Your mortgage is for $600 and it's been paid down probably too. Principal pay down over time, right? You still have lost zero money and gotten a 10 or 12% return. Where do you get almost a risk-free return of 10 or 12%? It's retardedly good. So real estate has to be a piece of that portfolio, even if you do it in a private capacity. Even if you reach out to a lending broker and say, hey, go put a mortgage on here. I'll pay you 3% of the mortgage of the return, and I'll take like 8%, and you can like lend it at 11. That's still a win. You didn't have to do any paperwork, nothing. Just give the money to the broker, sign some mortgage paperwork, done. Like there's no managing, no collecting. They do it all and deposit in your account. That's another way you can do things. You can lend out your RSPs, registered retirement savings plans, and tax-free savings accounts. So there's lots of options, lots of opportunities, I think, for substituting bonds for real estate. So that's what I do. In a 60-40 normal portfolio, we have 60% equities, 40% bonds. I just would take the 40% bonds and say, no bonds, and instead substitute for real estate or lending. It's much more preferred. The beautiful thing about lending, if you do it in a corp, is you go out to dinner and you work on the deal, you do a phone call, you write off a percentage of your home office, all of that against that income. So you get a bunch of write-offs. You basically created a business. And all you're doing is just putting a mortgage on someone's house and letting the income funnel into a corporation. Lending is an active business. You get 13.5% tax rate here in Canada on lending if you do it inside your corp. So you could, for instance, if you did enough lending, you get a car just to go drive by the sites that you're lending on. Maybe you want to check on your property that you have a mortgage on once a month, and that necessitates a trip to, if you put a mortgage on a house in like New York, maybe you want to go to, or LA, you want to just go to LA and check on that house every month. That vacation could be a write-off. So you can create a ton of write-offs around that and build a lending business. It can be pretty cool. And it's extremely passive. It's literally mailbox money. They pay their mortgage every month and you collect that into your bank account automatically. If they don't, you take their house. And then you get an agent in the town to sell the house and you get your money back. Probably with a profit because you bake in some fees if they default. So lending's great. Big fan of that from a passive income perspective. When I get to 10 million net worth on the journey for that, my goal would be to get that before 30. 29.9 would be the goal to get that 10 million. If I get 10 million, I just lend out 10%. That's $1 million a year. How can you spend $1 million a year? First off, like I actually don't know how it's possible to spend $1 million every single year. 10 million bucks will get you $1 million a year passive forever. So that's like, in my opinion, someone asked me, what is ultra wealthy? Ultra wealthy is $1 million a year in passive income on $10 million in assets. There are people who have $10 million in assets and they do not get those kinds of returns because they're very risk averse. Maybe they're sitting in treasury bills at 2%. So their 10 million bucks is like not growing at all or getting them any passive income. But smartly allocated, 10 million bucks is like, there's no need to ever have more than that. I don't think I'll grow when I get to 10 million, which it will happen inevitably. It's not a matter of like if, it's a matter of when. Like, will it happen before I'm 30? I don't know. Will it happen when I'm 35? Like, again, the probability increases drastically as time goes on. But yeah, something to think about. Steven, good to see you on. What's up? Okay, I'm going to read all of these out in a second here. And then I'm going to read, but first I'm going to read William's question because I promised I would. Hopefully, Tyler, that kind of answered your question. We can dive into it a little bit deeper here in a bit if you'd like to talk more about specific holdings that I would have. I like the Vanguard all-in-ones. I like a mix of like BRIC, which is Brazil, Russia, India, China. So like some emerging market stuff. I love my high growth dividend stocks. So like high paying dividend stocks. I love my dogs of TSX and dogs of Dow strategy, which is basically going on looking for the highest yield based on stock price. So the stocks that have been beat up the most tend to be the dogs of the Dow, the dogs of the S&P 500, the dogs of the TSX. It's a strategy where historically it performs better than the indexes, better than the benchmark, because you're buying high dividend yield stocks. You got to obviously analyze them. It's a good first screen to say like, hey, these are the best 50 yielding stocks on the Toronto Stock Exchange or on the S&P 500, on the Dow Jones. And you say, okay, these stocks are all paying, usually the dividend rate is like 5 to 8%. And usually that's because, and they're blue chip, a lot of these are blue chip. And so they've just been beat up for whatever reason. Their industry's down, their segment is down, they had a bad quarter, something happened. You got to investigate and say, hey, how likely is this dividend to continue? Because if they're paying an 8, like the big 5 banks in Canada for a while were on the dogs of the TSX. And like, do I think TD Bank or like Bank of Montreal are going to go belly up? They're backed by the government? No, I don't think that. So when they're paying healthy they were at a time paying 6% dividend yields, what we ended up seeing was a correction because they were on the dogs list. No one stays on the dogs list forever unless they go bankrupt. Then they just go off the list too. So no one stays on the dogs of TSX or dogs of Dow list for long. And so you'd use that strategy then to say, hey, these are probably undervalued. I don't know, but I'm going to buy like 30 of the dogs of TSX, and one of them's going to go bust, but 29 of them are going to perform well. The bank's doubled, so you get 100% of a capital gain on that. A lot of their stocks doubled recently after, and you saw the dividend yield drop to like 3 or 4%. So your dividend does go down as the stock appreciates in value, so that's something to think about. But that'll be a piece of my portfolio. And then I probably have like 5% that's just like stock day trading money, because I know day trading is not a success. There's no guarantee in day trading. Like no day traders ever like beat the market for like 50 years in a row. Even like guys like Buffett say that even the smartest of us will never succeed over a long period. Day trading is very unlikely. So what we know is that keep a small percentage of your portfolio for the high risk bets. Maybe they'll pay off big, maybe they won't. Have some fun with that money, but make it be a small percentage of your portfolio. Keep the lion's share of the money you have in safe things like real estate or blue chip type stocks, and be diversified. Don't just buy one property, buy 50. Don't just buy one stock, buy 1,000 stocks. Buy 10 exchange traded funds that each hold 100 stocks in them. Forget mutual funds, they suck. I'm gonna do a video on why they suck coming up in a little bit, about how your financial advisor or financial planner is probably stealing 75% of your retirement income. That's coming up in one of the Saturdays. Jesse, how you doing? Good to see you on. Mark, good to see you on. Tyler, okay, so Tyler has another super chat for $5. Thank you, really appreciate that. It says I will have a longer message regarding the Ontario tenant law posted. This chat limit is 150 characters. Okay, so you have to do it in 2 parts. But William, now I'm going to get to William's question. Now I finished Tyler's. So William, I'm scrolling. There's a whole bunch of people on here. Great to see you guys on. All of the regulars on from the main channel. If you do appreciate this, I would love if you could throw in a super chat. It would mean a lot. If we could raise like 30 or 40 bucks here, I know it's like a terrible hourly rate for me. I could just do a coaching call for like 150 bucks right now, and that'd probably be a better way to earn money. But again, I'm hoping that the audience is getting a lot of value. For all those people who don't donate, there's like 10 people who are getting value, right? So no problem. William, where are you here?
I'm not worth the rate you are.
No, fair enough. Fair enough.
It's heading my direction, so.
Yeah, that's true. That's
I'm
true.
not worth 150 bucks an hour yet.
Okay, so William has a question. My question was, what is the best way to teach your kids about money? So I did a video on this, William. You probably watched it. I think it was like how to teach your kids about money. And it was a couple of Saturdays ago, and it just touched the surface. But I think a piece of it is awareness of the value of a dollar. That's a good place to start. It's hard to create hunger, I think. How do you teach hunger? Like the hunger and drive to make money, that's a big piece of kids doing well financially. Like if you think about the kids that are most successful financially, William, it's usually the kids whose parents talked about money, whose parents valued money, whose parents taught like hard work. So one thing I like to do is I will show my daughter that I work hard. Like I will literally work in front of her and say, hey, we got to do our chores, let's do this and that, to teach her that hard work is an important part of life. The other piece is I talk about money. When we buy something, I'm like, oh, Emma, that costs $9. Do you know what $9 is? Do you know what else that could buy? And show her that like to get that $9, you have to work, an hour. And it's like, oh wow, that candy ring thing that costs $9, is that worth an hour of chores? And if it is, cool. But teaching that value, I think, is important early on. I have to think on it. I had a whole bunch of notes. Like I wrote like a 3 or 4 pages of notes on how to teach your kids about money. A lot of it's just introducing them to the concept of saving and introducing them to the concept of compound interest. We force our daughter to save a good portion of what she earns right now, but she actually enjoys it. Like when she gets money, she's like, oh, I'm gonna go put it in my piggy bank, and like we go to the bank and deposit it. And so she gets like a high from the saving of money. She sees it as like something special, like a treasure that she's keeping. And so I'm teaching her that money is important. I teach her that, like, why does daddy have to go to work today? And it's like, I'm financially independent, so I can't say it's like because we need it to pay the bills, but I try to show her that like daddy goes out to earn money in order to have nice things for us, a nice place to live, free to go do these activities. And so she sees that I'm working for money to get her things. And that's an important piece. I think the biggest thing is once your kids are a bit older, because I'm talking about when they're young, when they're older now and they know what money's all about, make them work for the money. Give them an allowance. That's really important. I plan to give my kids a salary. And with that salary, there's expectations of chores and things, but there are opportunities for bonuses, like getting good grades. I'll reward that. Or if you do more chores than what is your normal duties, that deserves a bonus. And so it's just like in the real world when they're 18 or 19, they start working, or 22 and they start working, they're going to have a fixed salary and fixed duties in the world, and then they're going to get extra money when they do extra things. But I'm going to hopefully show that rat race sucks, and that doing chores all the time and then getting an allowance, that sucks. A better way to make money, I'm going to show them entrepreneurship, and hopefully maybe I'll even buy a property, or I'll have her work for a down payment on a property, and then put the property in trust to her, and she'll learn to manage that property and all the pieces that go around with that, or some entrepreneurial venture, and then learn that she can make way more money than just doing chores. And so her time is more valuable than doing chores. So I'm hoping to teach the value of money through that. That's a big piece. And it works, I think, for anyone when they start to see that the richest people in the world earn their money through events. So event-based earning. Something big happens and they get a big payoff, right? They go for a long time earning nothing and then they have a big payoff. Entrepreneurship is this way. Real estate is this way. We often go a long time, delay gratification, and then have a big sort of payout, right, after a lot of work. So teaching them that money isn't necessarily like instantly you do something, you get money. Sometimes you have to do something like 10 times, and then you get a huge payout. And so that's a big piece of it, I think, too. And obviously the core principles of like how to budget and how to spend less, give them their allowance, teach them how to use that, right? And so if they can practice running their personal finances when they're kids or teenagers, then they're already rehearsed and ready to go when they're adults and they start having real salaries, right? So that's an important piece. I think I'm going to probably pay my kids a salary. Like literally I'll have my daughter do work in whatever company. I'm sure I'll have some companies when she's in her tween years, and she will have a position where she will work. Maybe it'll be $1,000 a month. It'll be a considerable sum of money, but she will work for that money. And there'll be bonuses and things for performance. And I think that teaches early on the value of money. Because when you have to work for it, you start to appreciate it. So don't give your kids money for free. Don't buy your kids things out of nowhere. That doesn't reinforce the right behavior. In some ways, kids are like dogs, and I think Pavlov had it right with his negative and positive reinforcement. But that's hopefully a sufficient answer for you. A goldfish best. Hey, how's it going? What is a super chat? So Janice, there's an ability within YouTube, and I'm not sure how you set it up, but there's a way to register to donate money effectively through YouTube. YouTube takes like a good portion of it, but it tells YouTube that my audience cares. And so if YouTube generates money, they'll promote it to my subscriber base. Right now, they're probably not even sending this out to all of my subscribers unless they're actually on the YouTube app. But definitely happy to earn a little bit of money for Kyle. So you're not donating to me. I got lots of money. You're donating to Kyle. You're donating to the business that is the YouTube channel, all the equipment that tends to break. And for us to get better equipment, we need those super chats. So that would mean a lot. For those people who want me to coach them, because I get a lot of responses for coaching, jump your questions in here for like $5, and I would happily answer them for the benefit of everyone. Cool. Okay, now I got to go through all these questions because I got Tyler's and I got Williams. Tyler had another question here. Okay, I'm going to read this one because he super chatted this as well. If you super chat, your question gets jumped in line. That's a promise. Okay. how is it that you're still comfortable investing in rental properties in Ontario given the rules and regulations? Fair point. Okay, 2.2% legal rent increase, all while signing a contract with a person with an infinite period of time without the ability to make changes. This is what's taking me out of the business and why I ask my first question to you. Good question. So, are there ways around the RTA? Yes. Is Airbnb a potential option? Yeah, you could go that route. You could hire someone to manage your Airbnb for you, and they would do everything, including maintenance. They're more expensive than regular property managers, but the revenue they bring in is way higher. And you don't have to worry about the long-term stays because it's all vacationers, short-term. So how do you maneuver through the Residential Tenancy Act? You get 2.2% a year. Here's what you do. Raise your rent when you rent out a unit. Make it nice. Raise your rent beyond what is the normal market rent. Like I'm talking reach, go 110%. If market rent is $500 a bedroom, get $550. Now, when someone's paying max rent and you keep increasing it 1.2% every year, so next year they pay $560, then $569, you're already ahead of the market rent. You won't fall behind in most cases. What you'll see is that at the higher rent range, you get a better quality tenant. The people on ODSP and Ontario Works and the poor people, they can't afford your unit. And it's not discrimination. If you can post your unit wherever you want, and the people who can afford the unit, you rent to. That's how it works. You have great credit and all these things. So you're already weeding out all the bad tenants. So you won't have any the crazy issues. You have a quality unit, you get a quality tenant there. The quality tenants, what I've found is most of them are reasonable people. Like 99% of them are reasonable. And so you won't have a lot of the problems that you have where you need to evict a tenant. And so you put someone in there, you're getting great rents, and it's okay. Because if you're getting $1,500 a month in cash flow, as you pay down your mortgage, it's going to get even better. Do you care? If I've got you a property, you're making $1,500 a month in cash flow, and you're getting like $1,520, next year, $1,525. A 2% increase, if your market rents are high enough, that 2% inflation increase will actually ensure that you move faster than the rate of property taxes and utilities increasing. So you won't actually lose cash flow over time. It'll improve. Plus, you'll have appreciation. So, it's possible that inflation, like rents will move faster than inflation. But if you started at a benchmark where you're above market rents, then you're in a really good position for like at least 20 years. It'll take a long time to fall behind. Where people fall behind on the rent is where they don't increase the rent with the inflation guidelines. That's really, really important. I do feel like at the same time, Tyler, there is that lack of passive argument that can be made, and finding a good partner to manage that is hard. And so I could see the justification in selling because it's like easy to just walk away. But if you could find someone you could partner with, that's a great option. Private lending is fantastic. You don't take any of the risk because you're lending, say, 75% loan to value, secured against the property. The investor does all the work. More likely than not, they maneuver through the RTA and get their tenants evicted. I've evicted not evicted. I've had most of my tenants agree to leave willingly. I'm like, hey, maybe my angle isn't your rent is low, but hey, I want to renovate your unit. I want to improve it. It's dated. Would you be okay leaving? And they'd be like, I don't really want to leave, but if you work with them, you're like, hey, you really want me out? I'm like, yeah, I really want you out. Okay, they work with it. Some people just leave willingly because you want them to leave. Then there's the next bunch who are like, how much are you going to pay me? And you just build it into your budget. Like if you're making 30% ROI, return on investment, maybe now you have to pay your tenants to leave every 5 years because the rents couldn't keep up with inflation, which probably isn't going to happen. But let's just say rents go way crazy high, faster than inflation, and you need to get that tenant out. They're paying $1,500 a month, and now market rent's $1,800, and you've increased their rent from $1,500 to $1,650. So you're $150 behind what you could get, let's say, in that scenario. You could pay them $2,000 to leave, and within a year and a half, you get that money back through the increased rent you get with the new tenant involved. So that's definitely an option. The greatest downside, I think, to real estate is probably, I would say the greatest downside is in the work required. Even managing the manager can be a bit of a pain. So that's where I like partnering. Joint venture partnership is key. If you can have a situation where, let's just say, see you, Kyle. If you have a situation where, I forget where my train of thought was going, but anyway, the point being, real estate's returns are so high that even barring those issues that come up, the return on investment is higher than the S&P 500, and so I don't feel so bad about it. Also, the risk is relatively low. I've not seen an issue where, like, if a house burns down, you have insurance, right? The tenant trashes unit, you might have insurance. If you don't, again, your cash flow is still so high that you should be budgeting for those times where that happens, right? And so the return on investment is really good if you use leverage in real estate. The next part of your question, so another thing you can do technically is work with a tenant who's reasonable and say, hey, I want to sign a 3-year lease with you. You're sign an N9. An N9 form is them giving you notice to leave. After the lease is signed, the next day, or you could date it for the next day, they could sign an N9, them giving you notice they want to leave. You can file that with the board, and they'll be gone at the 3-year mark. So you can make a tenancy have a definite end. People do it all the time. There are people who move here for a year and they're worried about, they're worried about being obligated to pay the rent. So they'll give you an N9 like months in advance, right? So that's an option too. You get that N9 signed or N11 signed where you can mutually agree to end a tenancy on a certain date. So the N9 and N11 form are within your power. If you know the RTA, the Residential Tenancy Act, you know the Landlord Tenant Board, there are ways to maneuver around it. It's not as bad as it does sound. It appears to me that the government is relying on us to pretty much provide subsidized housing. That is true in some situations. Don't put yourself in that situation. Be a smart landlord. We do the current balance is in favor of tenants, but most tenants don't know what they're doing, so it ends up leveling out between landlord and tenant. There are a lot of things you can do to, move a tenant out. Like I said, the most important thing is to buy a property vacant or be very skilled in working with the tenants to get them out. And then once you've placed your tenant at top market rent and a good tenant, and you increase with rent inflation, 2.2% every year, that's what this year's guideline is, you should be able to be on track with rents. You should be okay. You won't really run into a situation where you'll be like cash flow negative for a long time. And I mean, 10 years from now, your property's appreciated so much and it's a levered return. Like if the property appreciates 20% in appreciation from like a $400,000 property to like now 20% appreciation would put it at, $480,000, almost 500 grand. Your down payment was probably 100 grand. You just made 100,000 appreciation. That's 100% return on your money. And then also you got all that rental income over the whole time and the mortgage pay down. So you're probably in a really good position, even despite all these things. That's why we endure. We buy real estate smart. You make money on the buy. You buy undervalued real estate. You renovate nicely. You put in good tenants. You get great rents. All goes well. You buy a crappy condo in Toronto that is like $500,000 renting for $1,500 a month. That's a losing proposition. I don't want to be a landlord in Toronto unless I'm doing Airbnb, student rental, or like, I don't know, I got a really good deal on the property. It just doesn't make sense. You've got to buy where there's a lot of cash flow and margin for these problems. That's what it comes down to. We are paid so well for what we do if we buy smart. So just buy smart. There are a lot of properties I would never want to own for the reasons you're talking about. Because it is an anti-landlord environment right now. The tenant has most of the power. And you're right, they don't have to renew their lease, but most tenants will, especially the good ones. James, just popping in, what do you do for life insurance? I have a personal net worth that is large enough that if I die tomorrow, my family has passive income coming in that is much larger than they need to spend. So life insurance is irrelevant. I have life insurance on my daughter, the smallest policy possible, $25,000, and it is there simply because my car insurance and home insurance went down by triple what the policy cost to add. There was like a triple policy discount, and my policies everywhere else went down on home and auto and rental properties. That adding that policy on for $300 a year saved me like thousands on the other areas because I got a 10% extra discount across my properties. So that's why I got a whole life insurance policy for her. It's building some cash value too. It was free. That's why I got it. I'm not a huge proponent of life insurance unless your tax bracket's really high. Then you can use it as a tax shelter after only you've maxed out your tax-free savings account, RRSPs, and other tax vehicles. It is a last resort. The fees have to be better than the tax savings considerably. The tax savings have to be greater than the fees. There are a lot of fees in mutual funds that are baked in, like 5% of your investment can be gone to insurance fees, if not more. So there's a lot of fees with investing with insurance policies. Just be careful. Financial planners are selling you something that's good for them, maybe not good for you. So just do a needs analysis and confirm. Most people who are financially independent don't really need insurance unless they're in such a tax position where it makes sense. And if you're at the top marginal tax bracket, it would make sense. Good question. Now I'm going to scroll up. Oh, Tyler just jumped in here and said, my problem is I don't have the ability to refi. I have so much equity in my properties. So why do you not have the ability to refi? Could you maybe go to a B lender and pull some of that money out? Could you, and then maybe it makes sense to sell these properties and then partner with a guy like myself who could buy the properties and will get financing and buy the properties and put your down payment to work on a new property. Yes, it makes sense. Like a stock portfolio, you want to sell and rebalance. You don't buy and hold forever. That's not prudent real estate investing. People who buy and hold forever are not sophisticated investors. They're not sophisticated analysts. They're not prudent on their portfolio. The thing is, most real estate investors, you don't need to be financially smart. You don't need to look at your real estate portfolio like a stock portfolio. Most guys who buy real estate, they don't have that financial expertise and backing, so they buy and hold forever without analyzing. I sold 11 of my properties off in 2017 and 2018, and I timed it over 2 tax years for tax reasons. But I did that because I couldn't refinance either. And that was because I didn't know who to talk to. I didn't know the right people. I could have got refinancing probably if I had been smarter about it. But again, I sold and then I bought again. I had a pool of cash, went to the bank and said, hey, I have a whole bunch of cash here. I don't want to use my money. I want to use your money to buy properties. And I got high net worth mortgages approved, even though I didn't have the income to qualify. So sometimes it makes sense to sell and buy again. Nothing wrong with that. The beauty of real estate is having the debt, the leverage. Without debt, buying real estate in cash is not attractive. If you're going to buy real estate in cash, you're better off just lending to guys on first mortgages. You get way higher rates of return. So don't buy and hold in cash. Don't buy and hold when you have most of the equity paid down. I bought strategically, but I didn't renovate. Just rented crap holes to crappy people for 8 years, and I'm sick of the housing people in Hamilton for the rest of my life. So I think you just have the wrong properties. Probably a good idea to sell. Find a strategic way to sell smartly. But it definitely makes sense to sell. It's a lot of work. It sucks, Tyler. I've been there with you. I've got crappy properties in crappy areas with crappy tenants in them. It's the worst. I also want to sell some of those properties out of our portfolio. But that doesn't mean that the right property doesn't exist with the right split. You could just do first mortgages 10% and lend your money out, secured against real estate. It's safe. You can bring in a real estate agent and sell at any time, recuperate your money with money left over because you've got their down payment as well to lose first. That's a safe way to get a 10% passive income. You get $1 million sitting there, or $2 million in properties. You sell it off, you get $2 million. You invest that 10%. That's $200,000 a year forever. That's a pretty good gig. When I sold my 11 properties off in 2017, I thought the same thing. I looked at my portfolio. It was things that appreciated a ton. I'd spent a lot of money renovating, adding value, and my mortgage had been paid down with mortgage principal. And in 2017, I looked at my portfolio and I said, these 11 properties, they don't make sense. The other 7 I kept, but these 11 didn't make sense. They had a lot of equity in them, and the ROI wasn't good because I had owned most of the property. Went to the bank, tried to refinance. They said no. If I'd been smart, I would have found a way to qualify. There are ways to in the future, you may have better income to qualify. You may have better ratios, and things can change, right? But let's just say you can't. You got to do the best what you have, make the best decision with the information that you have. Definitely something to think about, I think, with so it's something to think about. You have to analyze your financial situation. I sold 11 of them off. Great decision, no regrets. Spaced it out from a tax perspective, and then reinvested and bought more properties. And bought them low, renovated them, created value again. And now I can sell them again if I want to and have a huge payout. But you get to a certain point where you have enough wealth that it's I looked at the equity in those properties and I said, what is my net rental income? And it was I was getting 10 or 11% return because I was mostly paid down. The properties had a lot of my equity sitting in them. So if you look at the return on investment equation, the more you put into your property, the worse the return. You want to put as little as possible in and get the most rental income possible with limited fees. So it just didn't make sense to hold those properties with such high equity splits. So I sold. And I said, look, worst case scenario, I'll take that money and I'll go and do first mortgage lending at 10 or 12%. And I'll get more cash flow for no headaches. No landlord problems, no LTB, no crummy bottom half of tenants calling me, just passive income. And so it's amazing. It's better than what you're going to get from dividend investing, but dividend investing will give you better tax advantages. You can collect $50,000 a year if that's your only income source, and the rest is in companies. Personally, you can collect $50,000 a year tax-free. If you have a partner, you can make them collect another $50,000. That's $100,000 a year tax-free from Canadian eligible dividends, that's attractive. So I could see the equity investing play, but the return on investment is again like 6 or 7, 8%. It's not as good as what you can get investing in real estate. So real estate has a lower risk, higher return. Yeah, return on equity, good point. Definitely, I just read that bottom question there. I don't look at return on investment, I look at return on equity. Very important. I look at return on equity as well. Very important. And if you've paid down your property a considerable amount, it makes sense to pull that money out and put it to better work. I'm going to scroll up now and get some of these questions up here. The chat's still going. People are still here. If you have a question, jump in the comments and throw it in there. That'd be great. Back on the main channel. Michael Chung, that's right. 100%. Can you raise the volume? We did that, so hopefully that issue is fixed. Check this out, guys. Mark, if you're watching this, I appreciate the tin cup. It's tin. It's metal. I've been drinking out of these cups. They're fantastic. And if you aren't subscribed to the channel, subscribe to the channel. So that was kind of cool, getting this. I want to read this book to you guys at some point. It's called Entrepreneurial Finance, one of the classes I took in 2013, 2014 at Ivy. Ton of good juicy info in there. I want to make some videos on it, do some case-based learning. Sorry, my phone was ringing. Okay, perfect, awesome, thank you. Would you buy a portion of Canadian dividend-paying stocks? Yes, I would, for the tax advantages. If you're at the top marginal tax bracket, it doesn't probably make sense. Dividends are not that much more attractive. If your only sources of income are a bunch of corps, so you can shelter the income, and then you can throw in, like personally, a bunch of dividend income that's Canadian eligible, that's a tax win in a big way, tax-free, essentially. So that's where it can make a lot of sense. For a few years, you could do that. Toronto or London? London. I am in London right now. I'm not in Toronto. For those people who have been following, you guys know that I bought that company in Toronto. I was just in Toronto like 4 days, staying in hotels. I'm glad to be home. I missed being home, and so it's nice. Nice to be back in London and check on my properties and make sure everything's going well. And we got a lot of projects on the go for September. We have a lot of tenants moving in, students moving in September, and I think we have like 100 people moving in. So that's going to be a huge move-in day. I'm dreading September 1st. Yeah. Even having staff, even having 10 or 15 or 20 people to help you out, you still have to manage all those people. And even if you have a project manager that's managing them, you got to manage the manager, which is a lot of work. So, yeah, not looking forward to that. Not even interested in buying any properties unless they're for my mentees. My mentorship program is awesome. I'm loving those guys' hunger and watching them grow. Michael, Chung, Jonas, Kyle. Hopefully Tony gets some properties when he's here. And then shout out to Austin and Antonio if you guys are watching too. I'd like to see you guys all get 5 properties. I'd like to JV with my mentees. That would be ideal, because think about it. Like if I had 5 mentees that all got 10 properties, that's 50 properties I'm partnered on. They're running the show. I'm helping them, right? I'm providing that high level of guidance to make sure they don't make mistakes when they're renovating, that they don't make, when they have issues, they can defer to me. They got a partner there. I'm there from the financing, capital backing, that kind of thing. That's the ideal, realistically. Being in the trenches, doing the work, it sucks. Even managing employees is hard. So for someone looking, saying, hey, what is my end game? What is my next stage? This probably isn't it. Like what I'm doing right now probably isn't it. I've made a lot of people a lot of money. That's been fun. It's always great making other people money. But yeah, truth be told, I could use a vacation right now. I could use a bit of retirement. I could scale down a bit. That's the, live streaming, God honest truth. I'm fatigued. I'm tired. It's a lot. We have like 300 tenants, and it's a real pain. Even though I have people in place, I have managers, it's still all of the shit slides downhill. And as an entrepreneur, you think you're at the top, but you're actually at the bottom of the hill, and you're at the last line of defense, and shit runs downhill. Excuse my language. Crap runs downhill, and you're the last person to catch it all. So that's what being an entrepreneur is like. The reward is worth the risk and worth the effort, but at a certain point, you get diminishing returns. You get so wealthy that, like, if I'd stopped right now, my passive income would be well into the 6 figures, well into the 6 figures. There's no need for me to keep pushing. And so it makes, on those days where I'm eating shit, it's really hard to swallow, because my why is helping other people make money, and I'm eating shit so they can enjoy life. That's a hard why. So think about that when you're doing your next business. I'm going to keep doing it because I've promised my word, and that's what keeps me going at this point. But Managing properties sucks. It's the truth. Renovating properties, it's hard. I much prefer to start businesses selling things than to be someone doing the management of like trades guys or tenants and things like that. So, anyhow, I love real estate for the returns. I love real estate for the money. I don't love it for any other reason. That's not true in other businesses. In other businesses, I have actual motivations and passions, like my YouTube business. I love this. Like, this is way more rewarding. My tenants don't, none of them come to me and say like, Mike, you've changed my life. Thank you so much. My customers on the real estate side, my tenants, they're all ungrateful and they're always trying to take, right? And it's like always a battle and it's not fun, but you make a lot of money. Like, I admittedly make my investors a lot of money. I admittedly have made a ton of money myself. And so, truth be told, we do real estate for the money. We better to buy the sector funds and not trigger any tax events, or would you trip with the dividend stocks? It depends on my tax situation. If I had no other income from any other sources, I'd want eligible dividend income, and I wouldn't really want to reinvest it. I'd want to take that out as a cash distribution to live on, and it's tax free up to 50 grand. So that's huge in Canada, right? If I'm in retirement, so it depends on your situation. I like the funds; they're great, but again, they have their tax disadvantages too. You have to factor in. Is it acceptable to finance a 14K Honda Accord that's 2016 EXL at 3% if I put 40% down? I drive a crappy 2001 Civic with dents, leaks, oil, and makes noise. I got car fever too. Future Wiz, it's up to you. I think at the end of the day, it depends. Is it going to materially change your life in some way? Do you feel like, having this new car is going to allow you to earn more money or to enjoy your life in a big way? If that's the case, then say, hey, what is the cost of this car, at like 3%? Maybe it's a few $100 a month in payments. Are you willing to work 10 extra hours every month to pay for that? And if the answer is no, don't do it. If the answer is yes, then do it. I personally am of the belief that you should buy your car in cash. I just don't feel good, and I know that like you're saying, should I take my savings and invest it in a car, or should I just borrow the money at 3%? 3% is cheap debt, and I talk about cheap debt being preferred. It is preferred, especially if your money is sitting there growing at 7 or 10%. But at the same time, I feel like you don't want to tie interest-bearing debt to assets that depreciate, and cars depreciate. Like in 3 years, your car's going to be, you buy it for 14, it's worth 7 or 8. So you're going to lose like 7 grand. Now, if you buy a car for 2 grand, like $2,000, it'll probably be worth $2,000 in 3 years because that's at the end of the depreciation curve. Now, it's hard to find a good car in that price point. I have been able to find a decent 2009 Ford Focus for 2 grand, and so it's at the end of its life. Like it's worth about now what I paid for it a year ago. Next year, it'll be worth the same as what I paid for it 2 years ago, or like 2 years ago at that point. So you get a fully depreciated car, it'll hold its value because a car that runs well is worth like a couple grand no matter what. Until it doesn't run well, and that's worth like $900. That's like the lowest value for a car, and then like the wrecker will give you $500 for it. So at a certain point, like this depreciation curve, you can take this steepness of the curve is very aggressive in the beginning. When you first buy it, it's like terrible, get off the lot, and then the first few years, it's like depreciates very hard. I honestly believe like a 2008 Ford Focus, 2009 Civic, or Accord might be a better option than the 2016. 2016 is going to have a lot more depreciation, so maybe compromise. Maybe you say, hey, my car's a piece of crap. I need something better. Instead of a 2001, I'm going to trade up to a 2009. There you go. You got a nicer vehicle. You find one with low kilometers. It's a compromise where you don't need to spend $14,000. Maybe you can spend like 6 or 5. And maybe you already have 40% down, so you have the cash to buy it. Now you have no financing payments, more money to invest in your financial future. But you know me, I am about debt with real estate. It makes sense. But anywhere else, consumer credit card debt doesn't make sense. Student loans doesn't make sense. It's a bad idea to go into debt for education. It's a bad idea to go into debt for stuff that doesn't provide value. Don't go into debt for stuff. Don't go into debt for bad assets, only for good assets. Rules of thumb there for you guys. Is it acceptable? We did that one. I'm getting out of the rental business to go 70-30 and ride that out. No more welfare. Baby mamas for me. Maybe, though, you could consider the alternatives we talked about where Instead of 30% bonds, you go with 30% lending. Reach out. I'll happily take your money and put it to work to buy. Like, I will buy properties with your money and give you a good return on it. No problem. Reach out to me. Like, we can security against real estate, whatever. Security against my net worth if you want. We'll use it to buy properties. I'll make the mentees do all the hard lifting. They're young and they're hungry, and they'd be happy to put your money to work and do all the heavy lifting. Fight with the tenants, evict them, renovate the property, go through all that struggle, because they're fresh and they've got the energy and they want the financial independence more than they want their free time. And so take advantage of that and make some money on that. That's the beauty of private lending. So that's what I would suggest. But of course, put some money in some dividend stocks too. Collect some of that passive income. Have a bit of, what do you call it? I guess the way to say it is, like, if you spread your eggs out everywhere instead of one big egg, you'll be better off in times of recession. They say that, like, spreading your wealth across many different places is smart. Diversification reduces risk. And diversification means owning many different investments. Janice, you're awesome. I'd invest in businesses of yours. Thanks, Janice. Reach out. Maybe there's an opportunity actually to invest in our medical business. There'll be an opportunity potentially there. On my flipping business, yeah. I buy properties and I turn them around. I'm realizing that I buy like the buy and hold method, right? I buy properties for $300. That's my value prop. We turn them into properties worth $400. And then I buy and hold, and I get no cash out. I make a small, tiny management fee, which barely keeps the lights on. And in the last year, I've made like $1 million, but we haven't sold any of the properties. So there's been no wealth created for anyone. The investors don't know how much they've made because nothing's been actually sold. So I'm like, geez, I want a proof of concept buy properties. And actually, like, it makes more sense to flip them in some situations. Now, I want to always buy a property that I can hold. Like, my flips are cash flow properties. In a recession, I can continue to hold. And that's always been my belief. I don't buy single family houses that have terrible cash flow. It's just not my thing, because in a recession, I'm stuck holding a property that brings me like $100 a month. I don't want that. I want to be able to flip it, have that option, and be incentivized and paid well to do that. So that's where you can turn money really quick. Like with flipping, if you can flip like 2 properties a year with that money, you can turn your cash quick and get a great return on your money, a better return than buying and holding in some situations. So that's where like borrowing money can be really, really great if you have the deal source. Otherwise, it doesn't really make sense to borrow at 10 or 12% unless you got really good deals to fund it. Or there's a lot of flippers who are just bad at running the numbers, and they're close to bankruptcy. In a recession, they'll be belly up. I see a lot of them on Facebook and Instagram. And not to say that I'm waiting for the next recession, but I mean, what separates a good flipper from a bad flipper is basically a recession. Like in good times when markets are appreciating, it's hard to tell a good flipper from a bad flipper. But yeah. Tyler, you made a few mil slumming it in Hamilton. I'm getting out of it. There you go, Tyler. I mean, that's fair. I was right there with you. Sold 11 properties off, and I was mostly paid down on them. And very similar position to yourself. I'm back in it for fun. 70% LTV making 12%. Damn, that's better than average. 7% on a 60-40. Yeah, exactly. Better returns. Xavier Sanchez. Hello from Ecuador, South America. Do you know if fire is possible here? I've been searching for info about it, and there isn't a lot, to be honest. What would you recommend is a good strategy? So, Xavier, the question I have for you is this. What does the average person in Ecuador make? Or what do you make in Ecuador? If you were to work full-time in your desired profession, what do you make? And then, what is the cost of living in your area to live an average kind of lifestyle, maybe a slightly below average lifestyle if you're a bit frugal? What would that cost? If there is a gap between what you're earning and what it costs, like what you can earn on average or what you have the ability to earn. So let's say you're earning like $20,000 USD a year. And let's say it costs you like $9,000 USD to live because your currency is, I don't know what the currency is like in Ecuador, but you have $11,000 gap there. That means that you can save $11,000 a year. You have like a 55% savings rate. That's fantastic. You'll be retired in like 10 years. So you can retire anywhere. The math is simple. If you can earn a lot more than you can spend, you can retire early, and the FIRE movement is alive and well in any country. It's easier to do in North America or a developed nation because the gap between what we earn on average and what we need to actually live, and I don't talk about the average person, I talk about what you actually need to live. Like, I can live like 20 grand a year and have a great life here in Canada. I know people will argue with me and say you need like 50 grand a year to live a good life. I disagree strongly. I live a really good life with a lot less, just by being frugal. But the point is that if there's a gap that exists, which there is in most countries, you can find FIRE and you can enjoy financial independence. So I would bet money that it's possible. For the average person in Ecuador, I don't know. People are traditionally, even in third world countries, very, very bad with their money. And so delayed gratification is a big piece of it. Next question. What is your opinion on out-of-state rentals? I'm looking to buy a multifamily near the University of Alabama. It's a fourplex, 160K, rents at 800 each, 2 bedroom, 1.5 bath. So 160 grand for the property, and you bring in 3,200 a month. That's 2% rule. That's fantastic cash flow. There is guaranteed a margin in there for a property manager to take over everything. I think it's a great use of money. Be smart about it. Make sure that that property you're buying is a good deal. Like, don't get crazy and buy something that's terrible. Go look at 100 properties there. Establish connections with some property managers. Have some backup contractors on hand, because your property manager goes on vacation. You needed someone you can call to fix something. But yeah, there's nothing wrong with being out of state. I prefer to buy properties close to me. But again, if I was in a market where I couldn't do that, then I would need to establish a team in that market. But totally possible. The cash flow sounds amazing. I would love to buy fourplexes for 160 grand that would rent for $3,200 a month. That sounds like the deal my mentee got pretty darn close to Jonas's in London. He bought a fourplex for 190 grand, which has the ability to rent for a similar amount. So that's attractive. Yeah, I would chase that. Definitely, Matthew. Keep in mind, guys, if you have a question and want to super chat, you can ask the question and it will stay on top of the screen so Mike can see it easier. Kyle, good point. Kyle is trying to raise money for the equipment and for Kyle. So super chats mean a lot, guys. Really appreciate them. Let's see here. Next question down the line. What's up, Steve? And then Tyler says, gotcha, equity and real estate lending. If I can get some first mortgages and write some of the office expenses, that'd be pretty genius. Tyler, let's have an off-camera conversation. Reach out to me. You got my email, you got my Instagram, you got my Facebook. You can find me. Find me, reach out, and let's have a chat about that. I will help you set up. I'll tell you how to set up a company to do the lending. Lend another company to me, or lend to my company, or whatever you want to do. If you want to lend to my personal net worth, that's fine. I'll give you net worth statements. We'll have a chat about that offline, and I'd be happy to put your money to work at like 10%. No problem. You got $1 million you want to put to work and make. $1 million would get you what, about 100 grand a year. That's pretty good. I can take that money, I can put it to work in real estate. So something to think about, but just be careful. Like, you want to invest, if you're going to invest with a flipper or invest with a real estate investor, make sure that they know what they're doing. Do your due diligence, that sort of thing. And I like if they have social media, because you can see what they're up to. That's key. More money's coming your way. Thanks. Appreciate it. I've been slowing down the buy and hold side, mostly because it's just a lot of work. Like, it's a lot of work to communicate with investors and then communicate that information from the investor to the contracting company to the tenants and all the back and forth. There's just a lot of that going on. And I wish I had a more efficient system. If someone could think of a more efficient system, that'd be great. At the moment, we spend way too much time. It's a lot easier if I literally just borrow the money and provide a guaranteed rate of return and then buy the real estate. Because when I bring people on as equity partners, I still will do it. Like, my investors who I see Eric in the chat here, like, Eric, we're going to keep buying properties with you. Like, you're a great investor. Easy to work with. You don't bug me a lot, so it's no problem. But there are times where it's been very difficult to deal with investors that, it's just another stakeholder to have to deal with, right? It's like another tenant, basically. Complicates the relationship. I think borrowing the money, buying good cash flowing properties, and then having full control is way better than, for instance, doing the whole partnership thing. But when you get started, it's hard to raise money. You have to have I have an established portfolio now. I have an 8-figure portfolio. It's a lot easier for me to borrow money now. When I was just getting started, I would have happily done, all the work to build it up. So, something to think about. The little guys in my mind are writing these asses off in the memory department. I don't know what that means. The little guys in my mind are writing these asses off in the memory department. What does that mean? I'm so lost. You have to clarify that. It must have been what I was talking about at the time, and maybe in context it makes sense. But Eric, good to see you on, by the way. Mark Smith. Hey Mike, do you invest in the Woodstock area? I do not, Mark, invest in Woodstock right now. It's a little bit far for me logistically, and I don't have a shortage of deals in London, so I've just not had the need. Hey Mike, good evening to you. Jesse, good to see you as well. Why not put your money in a corp and put yourself in dividends to avoid tax? So, Snake Eyes 11, great to see you on. By the way, you're a loyal follower since the beginning, so it's great to see you on the stream. Why not put your money in corp? Because you'd have to you'd lend your money into your corp and then have your corp lend it out again, and then keep the difference in the company. You could do that. That would be what I recommend if you wanted to collect dividend income tax free. You need like 50 grand of just dividend income is 100% tax free in Canada. The rest of your income has to stay in your companies, and you can't even dividend it to yourself because then it would put you over the limit, right? So that is one way to do it. I do earn a lot of money in my corps now. When you're just getting started, it doesn't make sense. Real estate is exempt from the small business tax at 13.5% unless you have 6 employees or more. So when I buy and hold now, I have a lot of employees. So when I buy and hold now, I'm actually an active business because I have 6 full-time employees or more. But if you're just an investor who doesn't have 6 full-time employees, you buy real estate, you're taxed at 50% in your corp. Doesn't make sense. Now, lending is an active business, so you get 13.5% tax. Lending's ridiculously good in a corp. But they're definitely put stuff in a corp. I'm gonna try to wrap this up really quick. Thanks, Fraz. Really appreciate the comment. Okay, Tyler, that's right. Fair point. Fraz is listening in. Good to see that. Brent, message retracted. I'm not sure what Brent was saying. You have to jump in the comments lower. Maybe you retyped it. Here's another one from you, Brent. Your dividend yield is not based on market price after purchasing. It is based on the unique price at which you bought the shares historically. Correct, Brent. But you could look at current price to current dividend payout, and you get a dividend yield, like a current yield on the stock. That would be what I would use to determine basically whether or not there's value there or not. So a big blue chip paying a 7% dividend, that's signaling some value, or there's something wrong with the company. So do a bit of due diligence. If there's nothing wrong with the company, then it's just undervalued. So that's a good opportunity. Or maybe see if the dividend's going to be cut, and we can talk more about that. Okay. We answered that question. Is Sarnia a good real estate market to invest in? Logan, I think Sarnia has opportunity. If you're living in Sarnia, Logan, I grew up in Sarnia area, so I'm very familiar. Sarnia has good cash flow. It's not that much better than London, surprisingly, despite being a really small, undiversified market. Like it's very risky, tied pretty much to the chemical valley, like Nova and the plants there. There's a lot of retirement people in Sarnia, but for some reason the house prices are actually quite high for what you get cash flow wise. The rents are much lower than London, so a duplex for 200 grand in Sarnia isn't necessarily as attractive as a duplex for 200 grand in London, because in London I'll rent those 2-bedroom units out for like 1,400 downtown, and in Sarnia I get like 900, right? So the rents are significantly different. The cap rates are not that much better in Sarnia, but yeah, if I lived in Sarnia, I'd be buying property in Sarnia. I feel good about it. Nova's expanding. The economy's strong there right now. It's a relatively decent sized city, 75,000, 80,000 people-ish. Wouldn't all the good deals be scooped up immediately when listed or even before? Why would a good deal sit on the MLS? Is there value in knowing the second a home hits the MLS? So Snake Eyes 11, yes. I've snagged up a ton of deals that hit the market fast that are great deals, and I've acted on them first, and the person who acts first gets the best deal. That said, I bought some great properties that were stale. Sat on the market for 4 months. Bad pictures, not explained well in the description. Maybe it had bad tenants in it. This happens a lot. Like, property would be listed, have bad tenants in it. 3 months later, the owner gets the tenants out, and all the people who went through it 3 months ago think those tenants are still there. And so I go in and I'm like, oh, the tenants are out. Sweet. Now this property's worth $100,000 more. Snipe it up. And it's stale, so no one's competing against me. Or I've seen this a lot where flippers will run out of money. They'll put the property up on MLS, and they're not finished renovating it, and they keep renovating it while it's sitting there in active listing. And so the property is getting more and more valuable the more money they dump into it. And so like a month after it's stale, and I'm like, I go through it a month later, and I'm like, geez, this looks nothing like the pictures. And they've put more money into it, so it's a more valuable property than it was. Or, yeah, it's just not marketed well. That could be an example as well. But definitely there are opportunities to pick up deals that have been sitting stale. Often people will reduce the price too. If it's been stale for a while, they get desperate, they'll just sell it for a good deal. And maybe it's not a good deal at list price, but at 80% of list price, hell, that's $100,000 off purchase price in some cases. Then now it's a good deal. Okay, what is a super chat? We explained that. Hey, how's it going? A goldfish best. Sir Dino, hey Mike, what's your thoughts on the 4% rule in retirement? If you don't have anyone to leave your money to, I think it's better to send the money spend the money until it's gone, I think is what you mean. You said send, but you meant spend. The 4% rule will ensure that you never run out of money. That's the beauty, like 98, 99% chance. And if you earn any other money through other like active sources of income and throughout the future, it will be almost 100% that you'll never run out of money. So I love the 4% rule. I personally retired on the 3% rule. Just want to be a bit more conservative. But if you have no one to leave the money to, just leave it to charity or do whatever. But at least you won't run out of money. That would be the worst. Being like 80 and being like, oh, my money's gone. That would be the worst, because then you'd be broke and not financially independent and rely on government money. Don't be in that position. That's why I love the 4% rule. It's a good rule of thumb. 3% rule is even safer. If you're in real estate primarily, you could rely on like 6 or 7% rule because the returns are a bit higher. Okay, word up. Janice, thanks. It's a great idea. Go Kyle. My problem is that I don't have the ability to refi. I have so much equity in my properties that my return on equity is crap. We talked about that already. Exactly. Return on equity is very important. When you pay down properties and you can't refinance them, then it's the option to sell. But if you can refinance them, maybe with a B lender at 4 or 5%. We did this one already. We did that one already. Fair points. Andrew, good to see you on. Jittery video, or is it just me? Not sure why the video will be a bit jittery. I'll have to watch the replay and see what's up. I was close to my DCR, was just a little bit too short. When you sell, you're paying realtor fees and triggering capital gains. I have close to $2 million in unrealized real estate gains that I'm going to be selling. So Tyler, maybe you could consider an option where you sold the property with a vendor take back. Sold it to someone in Hamilton. They probably connect you with someone who bought the property at, whatever, and they did a vendor take back. So you could set it up where like you didn't get paid out entirely, or you brought them on as a partner and then they managed the property and you cut them in over time. They bought you out slowly. Then it's like the gains are over time. You could also just sell a couple properties every year over the next little while. That's an option too. So yeah, you could be strategic about how you sell it to avoid the capital gains. At least it's a capital gain. So that means that it's half your tax rate. So it's half inclusion on capital gains, which means the most you'll pay is 25% tax. On $2 million, that's 500 grand. It's considerable. If you could spread that out over a couple of years, or be creative about how you sold it over time, slowly collecting the payment, that's an option too. And then you'd be in a situation where maybe your tax burden's a couple hundred grand instead of 500 grand. Something to think about. Yeah, man, I'm going to be... Okay. Yeah, exactly. You could spread it out. That's an option too. You have to think through it. When you sell it, there is technically a gain paid immediately, and then you have interest income over that. So VTB might not really be a good option, but you could sell a portion of the property through a joint venture partnership, and that would be smart. I'm sure there'd be someone who'd be interested in buying part of your properties and doing all the work. I could probably put something out there and on Instagram, and someone would reach out to you. So reach out on that, and we'll see what we can do. Okay, you're right. Realtor fees do add in, and there are fees to sell. Legal fees are not much, like $800 to sell a house, $900 maybe. It's not as expensive as when you buy if you have a decent lawyer that's not from Toronto. Okay, smash the like button, Steven. That's right, 100%. Smash the like button. Engage in the video. That's great. I love it when you guys smash the like button. If you're still watching the replay, I really appreciate it. Share it around. Let's get some watch time on this. If I'm going to bring the videos back to the main channel, I want to see how they affect my Saturday videos. So we're going to see. Holy crap, 300 tenants. Yeah, it's a lot. 4% rule never sounded sweeter. Yeah, I'm pretty burnt out. Even though we have managers and people in place, 1% of the situations roll back to me, and so I'm still dealing with stuff, which sucks. So, is it best to spend all your money in retirement if you don't have any kids to leave the money to? Instead of the 4% rule, do like a 10% rule until the funds are gone. You could do that. The risk is that you end up alive, or like the singularity happens and we live forever, and then you have no money left. I don't know how likely that is, but what if you thought you were gonna live to 75 and you live to be like 100? That would suck if you spent too aggressively. Find someone to leave the money to. You probably have someone or some charity or some fund you could leave it to keep giving after your life. But you could. I mean, yeah, you could spend more aggressively and enjoy your life, more now. Maybe you spend it like a 7% withdrawal rate, and you risk, having nothing left. The nice thing with real estate is it's hard to spend it all. You just spend the rental income until it's gone. And you still have the asset. It's hard to spend, right? Same with stocks. If you don't sell the stocks, just sell, like live on the growth, right? As you get appreciation, sell off the shares that are equivalent to the appreciation. So your asset base never changes, and you probably never have an issue. Do I need a programmer? Currently, I don't have a need for a programmer, but reach out. Maybe we'll set something up. There's always opportunities. We start new businesses and things like that. I'd be interested in getting into the software space at some point. Jesse says, preach the truth, Brahms. Buddy, I would love to get to your level, but a little slower to avoid that burnout. Hey, nothing wrong with that, Jesse. Nothing wrong with it. I can use some retirement right now myself, to be honest. I'm burnt out. Jonathan Wood, keep up the inspiring content. Thank you. Appreciate that. Great. Awesome. Thanks, guys. I've done the math, and yeah, there is a gap. I make $25,000 a year, and I can live on $10,000 a year, so roughly more than 50%. Yeah, that's great. That's like 62.5% or more. The problem is I want to invest that money on mutual funds, etc. Don't invest in mutual funds, Xavier. The mutual funds fees are too high. 2.5% MER is gross. You could just go buy like exchange traded funds. Much, much better. ETFs. Same thing as mutual funds, but lower fees. Totally fine to do that. Instead of saving it in the bank, however, I think I'm not allowed to invest in mutual funds in the US. I'm new to the FIRE movement, but just wanted to find a start to follow. Yeah, Xavier, definitely you should be able to buy publicly traded stocks in the US. I don't think there's any rules in Ecuador against owning, shares in companies foreignly. That I doubt that exists. So you should be able to do it. Yes, I'm on Facebook, Janice. I have a public page and I have a private page as well. And yeah, I'm on YouTube, I'm on Facebook, I'm on Instagram like crazy. Yeah, I'm still going. Kyle's back. What are your thoughts on Ricky Gutierrez? Have you tried day trading? I like Ricky Gutierrez. I follow him on Instagram. He's a young guy. He's doing a lot. He's hustling. He's got some nice cars and lives a really nice lifestyle. It's not so much about the frugality, but I really do love a lot of what he talks about. I think that, what do I think? Be careful, because I like the guy a lot. I don't want to throw shade. I think that day trading is hard to replicate. I think in a down market or over like a 10 or 20 year period, I'd be surprised if his return on investment over like the next 25 years, if you track his actual return on investment, I'd be surprised if it's much higher than the S&P 500. Yeah, I'd be surprised. Most patterns and algorithms programs that work now break in 2 years. Too many people find out about them, then it breaks. Like no one is smarter than the market over the long term. 0.1% of people are smarter than the market, and yeah, it's very, very rare. Once you get a lot of money, like if you had millions to play with, it gets harder and harder to day trade well, I think. So that's something to think about. I'm not a big fan of day trading because it's hard to replicate. It's very, very hard to teach it and replicate it. Real estate's easy to teach and replicate. Buying ETFs is easy to teach and replicate. It's dead simple. It always works. Like 80% of people try day trading. I'm just making up a number, but like a large majority of people will day trade and lose money. Pretty much no one invests in real estate and loses money. Pretty much no one invests in the S&P 500 and loses money. Like you guaranteed to make money. So that's why I like to propose those as opposed to day trading. William says, bath time, Mike. One more question. How much leverage did you use in the company to purchase? How did you fund the deal? Yeah, so we got bridge financing. We're looking to bring in like an A-lender bank at like a cheap 3% cost of debt. We financed it, what did we end up putting down? 25% down at the end of the day, 28, maybe 30% down of the purchase price. And we financed the rest. We're going to refinance all of our money out. It's going to be a full burr on this business. That's the plan anyway. So we'll see how it goes. We're going to work really hard and try to get sales up and costs down, and it'll be hopefully a big win. So if you're interested in like buying our products or following along, our wipes and our pillows are pretty fantastic. The memory foam pillows have like spots for like hoses and things, and some of the kid products are kind of cool with the kids wipes. Been using them and they're great so far. So recommendation to check those out. You're right, it is bedtime, and my kids are screaming. If you guys can hear it in the background upstairs, it's bath time. I gotta go super speed. So I'm gonna do rapid fire, and then we're gonna wrap up the stream, and I'm gonna do my catchphrase that I always do. I'm seeing a lot bigger properties on my side of town. How much easier is it to turn a single family into a duplex? Very easy how to save. Follow me on Instagram. I talk about the duplex conversion process. Here in Ontario, you can just do it's called a secondary dwelling unit conversion, which allows up to 40% of the space to be converted to another unit without duplexing, without zoning changes at all. Any property can do it. So that's the beautiful thing. Check it out. Also, a solid duplex just came up in my area. It's an absolute bidding war. Wish I had more cash to close and jump on the deal. Good things come to those who wait. How to save? Good point. If it's a bidding war, maybe it makes sense to back up. You don't want to overpay. So it's okay to walk away sometimes in a bidding situation and say, hey, I'm going to find another deal. Because the person who wins in a bidding war sometimes loses. Work harder. The national debt is not going to pay itself. Work, libtards. Red Sox 101. Thanks for that comment. Yeah, I'm paying my fair share of the tax. Don't worry about that. I'm sure the Liberal government here in Canada will find a way to spend no matter how much I pay in tax. They'll find a way to spend it. I was thinking about a VTB. We talked about that. Hello, L. Good to see you on. Tyler says, yes, on the path, 1 to 2 max selling per year. Any more than that is too much tax. I ran it on Simple Tax Calculator. Tyler, definitely have a good chat with an accountant about a strategy. We should have a chat. If you want to do some lending, I could help you free up that capital and do it in a tax advantaged manner. Just as like a friend, I'll just share my thoughts. I'm not a professional CPA. I abandoned the CPA path when I didn't accept my offer to go back to KPMG after 5 months working there. That's a story for another day. Definitely we should talk. Mauer Funds, Best Vanguard. I haven't checked them out. I don't know what Mauer Funds is, but I like Vanguard a lot. Big fan of their low fee structure on Boglehead. Jonas jumping in and buttering me up. Mike's easily the best mentor anyone could ask for. Thanks, Jonas. Appreciate that. Thank you for answering our questions, friend. No problem. I lost 50K day trading. Glad it wasn't 100. Geez, yeah. Like if you poll people on average, most people lose money. That's the problem I have with like the Ricky Gutierrez's of the world, is they're saying like anyone can go and make like $2,000 a day trading. And like the reality is like 9 out of 10 people will make money for like a year and then lose money, but will eventually lose money. My experience day trading, even with a degree in finance and accounting and economics, was I don't know more than the market and I can't pretend to know something someone else doesn't. And when I would trade on information or historical like analysis trading or value investing trading, what I'd find is that most of the time I was not smarter than the market. And that the lion's share of the time I would just get like S&P level returns, which in the last like 4 years is like almost 100%. That's great. But you should expect like 8 or 9% every single year. But you'll have fluctuations. So as a day trader, you'll make 100%, then you'll lose 100%. Then you'll make like 10%, then you'll lose 10%. You might have a stop loss in, so you never lose more than 10% at auto sells. But the point is the same, that the return is not necessarily any better if you look at the data over the long term than just buying and holding stock in aggregate. Is 15,000 net income from a property that costs 200,000 good? I would say yes. I would say that's pretty good. It seems like a decent return for relatively cheap property. Tyler's got a duplex for you. Gage Park area, Hamilton, 1425 rented out. Empty unit 2. Come out for 1550. Everything is separately metered. 2 hot water tanks, 2 furnaces, 2 hydro panels, 2 ACs, 2 water meters. Tyler, here's what I'll do for you. I'm a realtor, so it's actually really easy for me to sell your properties. And I probably do it for less than any other realtor because I don't need to sell. I don't need the commission. I bet you I could go down to Hamilton, do a drive down, have some fun. Kyle and I could go down there, pair gas or whatever. We'll go down there. We'll shoot some videos in Hamilton, and I will find someone to take over all your properties with VTBs, like in my network, in one video. That's an option. But anyway. Okay, you reach out to Burlington. I have everything you need. Whatever you need to eat, drink, smoke, girls, to massage your elbow for an hour. It's all here. And we'll bring the whole mentee crew. Maybe the mentees want to I guarantee there's someone I could set up an infrastructure in Hamilton and take your properties over. If you are just done, that's no problem. That's literally what I do. I actually bought out a guy here in London that had like 6 or 7 properties. He was just tired and done. I'm hurrying. I'm coming. All right, I gotta go. It is bath time, and it is 8:37. I went too late. Live in Houston, Texas. Reach out to Burlington. Look forward to more info on duplex conversions. I heard you. I yelled. Don't worry, I'm coming. No videos though. Maybe if I'm wearing a ski mask. All right, Tyler, no problem. We can just do it so like you're totally off camera. That's no problem. Yeah, no problem. We'll just do the properties. I'll literally bring a balaclava. That's a ski mask. You can wear that if you want. We can walk around the properties. Kyle knows how to do that too. We could definitely distort the voice. That'd be fun.
Yes.
But I know fair market value. I'm no sucker. Exactly. But the thing is, here's the thing, Tyler. There are people who have not a lot of money, but a lot of energy, and will pay top market value for your property if they can get a vendor take back because they can't qualify for a mortgage. So that's a situation where with the VTB, you can get top dollar for your property, and it's a win for the person getting involved, like the mentee or whoever it is, because they got the energy, but they can't qualify. So that's where you can create a win-win scenario, and like you'll actually get a good price for your property. Maybe even could get like 105% of market value because they're in a situation where they now get to walk into a property, make $1,000 a month to deal with the tenant problems and headaches. So that's where you create a win-win. I gotta go. Yeah, you can hear the babies crying, right? Like it's actually I gotta go. But yeah, Tyler, definitely reach out and we'll set something up if there's an opportunity there. Ouch, that's a hard comment. There you go. You see, clean up the bad tenants already. So win-win. I gotta go. I really do have to go. Thank you guys so much for watching tonight, and for all the people who super chatted. Thank you. It means a lot. Let me get that money to Kyle, net of the YouTube fees. Let's do the experiment and see if the videos on the main channel do better or help my Saturday videos do better. We'll see. There you go. I'm not going to read that on camera, but you guys can read it in the chat for yourself from Tyler. The secret to unlocking a wealth through you is to spend less, earn more, and maximize returns on the difference. Thank you everyone so much for watching, and smash that like button and jump in the comments and let me know what you thought of the video. I do this out of the goodness of my heart, so appreciate the support. Thanks everyone.